Welcome to this lecture video. In this lecture video, we shall use Excel to perform portfolio optimization for two assets, in particular, the mean variance portfolio theory by Markowitz. Now, our major focus is to allocate optimal risky weights and then compute the expected return, the volatility, and the Sharpe ratio. Thereafter, we shall proceed to obtain the efficient frontier curve, which is a parabola, and the capital market line that makes a tangent with the efficient frontier curve. The efficient frontier curve is parabolic in nature, just as a case of a quadratic equation where you could obtain a curve. Then the capital market line is a straight line, tangential to the efficient frontier curve. So it makes a tangent with the efficient frontier curve. All right, in this video, particularly, we are restricting the assets to only two assets. But of course, it could be extended to as many assets as possible. So we look at here, the two assets. Asset prices for GlaxoSmith and BAT. Observation ranging from the date 21st of November 2016, 18th of November 2016, down to the last observation. So we have all these values down to 11th of June 2015. So the data sets, which in this case represent the time series data for asset prices of GlaxoSmith and BAT, ranges from 21st of November 2016 down to 11th of June 2015. So we have over 1 year observations. All right, the first task is to obtain the return for the two assets. So here, the return for GlaxoSmith will be, since the data set are arranged in descending order, that is the time series, values or observations. So it means that this value, beginning with GlaxoSmith, this value is the current asset price, while this value is the previous asset price. And the return will be the current price minus the previous price over the previous price. So if we do this, then this will simply be, in parentheses, B3 minus B4 over B4. And then we enter. So we now have the return in the first instance for GlaxoSmith. Highlight this cell, move your cursor to this point, and then drag it down. So it will do the same for BAT. So you don't need to do it one by one. And you could go further and drag it down up to second to the last observation, because the last point here will be not applicable or not available rather. So we'll stop at this point. So you could see that we have the returns for both GlaxoSmith and BAT. In some cases, the return could be zero, which is to say that the current price and the previous price are the same. So if the current price and the previous price are the same, then the return will be zero. So there is zero return. All right, what next do we need to do? We need to compute the average daily return and the variance daily. So to obtain the average daily return, we use this in Excel. Of course, it's inbuilt. We have AVERAGE. You could use uppercase or small case letter. It's not case sensitive. So the average, beginning with GlaxoSmith, so we'll go down to GlaxoSmith, and then we take from the first observation, which is E3, down to the last observation. And the last observation here is E376. Close the bracket and enter. You can also drag it down to this point. So it will do the same for the BAT. Moving on to the variance daily. So we'll take the variance VAR. Don't be confused. You may have VAR.P, that is for the population variance. Then VAR.S, that is for the sample variance. But by default, we'll take just the VAR. Excel will do it correctly. All right, so the VAR, that is the variance for GlaxoSmith. Highlight the observations from the first to the last value. That is the variance of these observations from E3 to E376. Enter, and we have this result. Again, highlight and drag it down to this point, and it will do the same. Now, what we need is the annual average return and then the annual variance. So we want to annualize. To annualize in this case, you don't need to multiply by 360, 365 days, making up a year. No. As a standard approach in finance, we multiply by 252, 252, if converting from daily to annually. For the mean and the variance, we can multiply by 252 each, while for the standard deviation, you multiply by the square root of 252. But at this point, we just need the mean and the variance. So here we have this mean, which is cell E380, multiplied by 252. And it's done for us. You could drag it to this point. That's also fine. It's also done for the BAT. Similarly, for the variance, we take this variance daily and then multiply by 252. And it's done. We can highlight this, drag it down to this point. So we now have all the values we need for the two assets. The annual average return and the annual variance for GlaxoSmith and BAT, respectively. We want to bring this information here so that we could use it for other analysis. So here we have, another point. So here we have the mean return, and then we have the standard deviation for GlaxoSmith, the same for the BAT. So we've already computed, so we simply bring it here. Now we can also use the option of transpose to copy and then transpose and paste it. That's also fine if we do that. But rather than doing that, we want to do it in a different way now. So we simply go back to this average annual return. So this is what we need. E382. Enter. So that's done. Again, the average annual return for BAT is this, F382. What do we do? What do we need to do next at this point? We also need the standard deviation for GlaxoSmith and for BAT. Now, the standard deviation will be the square root of the variance. So we'll take the square root of the variance for GlaxoSmith first. And for GlaxoSmith, we have this. E383. That's the cell containing the value for the variance. So the square root of the value in that cell. We have this. Similarly, the standard deviation for BAT is this, F383. We close the bracket, enter. So we have the mean return and the standard deviation for GlaxoSmith and BAT respectively. What do we need to do next? We need to obtain the variance covariance matrix. But before you do this, always ensure that you have the data analysis package and the solver package, Excel solver. So these are two packages we need. In a situation where maybe you're using a PC that you're not sure whether the package is there or not, then you simply go to the top icon and click on data. When you click on data, then you double check, have we got it here or not? You could check at the top right, you will see data analysis and solver. So we have the two packages, the solver package in Excel and the data analysis package. The solver as a package in Excel is used to perform optimization, especially in this case, the portfolio optimization. You could minimize or maximize. So both minimization and optimization problem could be done in Excel using the Excel solver package. While for statistical analysis, we use the data analysis. For instance, the correlation, the covariance, hypothesis testing, and so on. We could use the data analysis package. All right. Now, where you don't have it, then you move to the top left, click on File. From File, go to the last icon, which is Option. You click on Option. Then from the drop-down menu, go down to second to the last icon, or item rather, second to the last item at the bottom, Add-ins. So click on this Add-ins. Don't say OK yet. Say Go. Click on this Go. So don't click on OK. You need to click on Go instead. Now, in my own case, I've already installed these two packages in my PC. So I have it here. For the PC I'm using, I have the packages in Excel already. So I don't need to worry. But where you haven't got them, then you need to tick the analysis tool pack for the data analysis package, and then the solver add-in for the Excel solver package. And then, okay, then that will be done for you. You will see a blue flashing beacon within few seconds to indicate that it has been successfully installed for you. All right. So at this point, we want to do the variance covariance matrix. So we'll go to the data analysis and then covariance. So this is what I want to do at this point. Now I need to empty it because I'll be using this for other analysis. So let me now start afresh. So input range. In case you have other values you don't know how come, make sure you get rid of everything. And then you start all over. So we have input range. So we want to impute the range. At this point, the input range would take the data set that is for the daily returns for GlaxoSmith and BAT. Include the variable names. You also have the option of excluding the variable name if you only need the observations, but it's advisable to include the variable name so that Excel will also show us the variable name and their values for the variance covariance matrix. So include these variable names, drag it down up to the last observations. So that has been done for us. Then what do we need to do next? Group by columns. That's fine because the data set are grouped by column. If it is by row, then you take the row option, but in this case, it's column. Labels in first row, because we have GlaxoSmith and BAT also included, so it means the first row represent variable names. That's the labels in first row. Then the next is where you want the result to be. Where do you want to paste your result? Should it be in the new Excel workbook? That would take you to a different workbook completely. Should it be in the same Excel workbook but different sheet? That will be the new worksheet plan. But what we want actually is to paste the result in the same sheet. So to do this, click on this tab or this box rather, and then where do you want it to be? I want my result to be here. The variance covariance matrix. Then I tell Excel to go ahead. Okay. And the result is there for me. Now remember, these are the daily returns. So we still need to analyze the values in the variance covariance matrix. So click on this first value. You could see that this is the variance. Multiply this by 252. Enter, and that's done. For this that is not going with a formula, just a numerical value, that is for the covariance. You will notice that for the variance, you will not have the variance have formula already. While for the covariance, no formula. So you would need to include here, just before the numbers, equal to should be there. And after the numbers, multiply by 252. And then you have this. Then note that this value is the same as this value because the covariance of X and Y is the same as the covariance of Y and X. Take note. So it means it is symmetrical. The covariance is symmetrical. Covariance of X and Y is the same as the covariance of Y and X. So it doesn't matter which one comes first. Now you notice that the variance is always positive. Variance is positive in nature, but the covariance could be positive or negative. So what does the covariance tell us? Even though both are measures of dispersion or variability, what the covariance tells us is whether two variables are moving together in the same direction or not. So if you look at this, if the covariance is positive, then it means the two variables are moving together in the same direction. But if the covariance, that is, if the covariance is positive, if the covariance is positive, the two variables are moving together in the same direction. But what if it's negative? If the variance is negative, if the covariance is negative, it means the two variables are not moving together in the same direction. So they could be moving in opposite direction. I take it again. Covariance positive. The two variables are moving together in the same direction. Covariance negative. The two variables are moving in opposite direction. They are not moving together in the same direction. Take note. All right. Having said this, now remember this also, we haven't done anything yet, so we have to do the same, multiply this by 252. And that's done for us. Then this is equal to this value because it's symmetrical. That's why we have covariance of XY is equal to the covariance of YX. So it's symmetric. Now, alternatively, we could also work out the covariance in this way. Covariance of GlaxoSmith and BAT. This will be equal to COV. Again, we have .P, .S. .P is for the population, .S is for the sample. Yes, we know that we obtain these sample observations from a population. So by default, we simply need to take the COVAR, covariance, in parentheses, then the asset prices. So you take this, Don't include the variable names if you are using this inbuilt in Excel. So we'll take this for the first instance, that is from E3 to E376. And then the second. For the second, this will be, we'll go back again from F3 to F376. So this is covariance of array 1 and array 2. So we impute both array 1 and array 2. Enter. And then we have this value. Again, we need to multiply this by 252 so that it will be analyzed. Now look at this clearly. If you look at this, you will see that clearly the covariance here is the same as this covariance. 0.00401622. So whether we use the inbuilt in Excel or we use the data analysis package, the result will be the same. And in this case, the covariance of GlaxoSmith and BAT is positive, which is to say that both GlaxoSmith and BAT returns are moving together in the same direction. All right. I haven't done this. We now move to the next phase. Before optimizing the portfolio, we want to do the first analysis where we will have equally weighted portfolio. So we first of all assume that the proportion of investment is the same for the two assets. So here, since it's just two, then each of them will have 50%. And as a rule of thumb, or a necessary condition, the sum of the weights must be equal to 1. So the weights must sum up to 1. So in this case, W1 and W2 must be equal to 1. So you can't have a number different from 1 as the weight. So the sum of this and this is equal to 1. So that's fine for us. And then we also have the risk-free rate. Now, there is no complete risk-free. We can't have zero risk. No matter how small it could be, in some cases it could be so negligible, very close to zero, but it is still different from zero. Now, it is risk-free in the sense that it could be approximately zeros. For instance, if you round this to 1 decimal place, this will be 0.0. But if you include all the digits, you see that it is not exactly zero. So it means that this is smaller risk, the smallest amount of risk that could be taken. Now, what we want to do at this point is to compute the expected return. So the expected return here takes the form of linear combination. So what we have will be W1 times R1 plus W2 times R2. So we assume that this R1, R2, W1, W2. So we simply multiply the weight of GlaxoSmith by the mean return for GlaxoSmith plus the weight of BAT by the mean of BAT. So if we do that, we obtain the expected return for the portfolio. So here would be equal to, in Excel, we use the inbuilt matrix multiplication, M-mult. That is matrix multiplication. So matrix multiplication, then we take the weights. But before you do that, you need to transpose. If you do not transpose, you will have a wrong result. In fact, it will not even give the result. It will return an error that is infeasible. So to make it feasible, since we're dealing with a row vector, column vector, we need to ensure that the multiplication is feasible. So we need to transpose the weight. So this will be the matrix multiplication in parentheses, transpose the weight. So we'll transpose the weight here, comma, and then we're multiplying by the respective return. So this is what you will do. Matrix multiplication, transpose of the weight, and then comma followed by the mean return for the two assets, close the bracket and enter. Then we have this result for the expected return. We move on to the next, the standard deviation. This will be the square root. Remember, it is not case sensitive. So we could use small case letter, SQRT, or uppercase letters. No issues. So the square root, in parentheses, matrix multiplication, in parentheses again, matrix multiplication. And then what follows? Remember, the standard deviation will be the square root of the transpose of the weight multiplied by the variance covariance matrix and multiply again by the weight. So we have as the square root of W transpose covariance of the two assets and then the weight again. But the covariance will be the covariance matrix place. So what do we do at this point? This will be the square root of matrix multiplication again, then the transpose of the weight, W1 and W2, comma, then the variance covariance matrix. Highlight this, comma, and then the weight again. But make sure you put, okay, let me do with this first. After this, close the bracket, please. We close the bracket, comma, and then we take the weight again. Then double close the bracket. In case you have an error, always double check. For instance, maybe where you are supposed to close the bracket, you could not close the bracket. Make sure that it's done, don't panic. And the moment you instruct Excel to do it correctly, Excel will compute and return the correct result for you. So now we are set. We can now tell Excel to go ahead. And this is the result for the standard deviation or the volatility of the portfolio. What next? Do we need the Sharpe ratio? So the Sharpe ratio is a measure of the expected return per unit of risk. It's also known as the reward to volatility. So at this point, our Sharpe ratio will be this expected return minus the risk-free rate over the standard deviation or the volatility. And then we have about 69% as our Sharpe ratio. It's a positive Sharpe ratio, which is actually good, and the value is numerically high. But we might not really be happy with this. We're not satisfied at all. Must we invest the same proportion on the two assets, 50-50%? What if we go ahead to optimize? In this case, working on optimal risky portfolio, where we will assume that they do not have the same proportion of investment. You can invest different percentage on GlaxoSmith and then BAT. So both should take different proportion of investment, but the sum of the proportion should be equal to 1. That is what we want to do now, which is optimizing to see what amount do we need to invest in GlaxoSmith and what amount should go to BAT in order to maximize our Sharpe ratio and minimize risk where applicable. So at this point, we go further to the optimal risky portfolio. We will do exactly the same before we proceed to use the solver package to obtain our final result. So here we have, for the GlaxoSmith, we have 0.50. That is equally weighted in the same way as we have for the first instance. And then the sum of the portfolio weights must be equal to 1. The weight sum up to 1. Then the expected return. What is this expected return? Matrix multiplication. I'm doing it again. I could just copy this result and paste here, paste the value with no issues, but I just choose to do it again. So matrix multiplication, transpose of the weight, and the weight will be these weights. And then you're multiplying it by the respective returns. So the return, mean return for GlaxoSmith and BAT. So we now have this, enter, which is the same result. Then the standard deviation is the square root, in parentheses, matrix multiplication, in parentheses, matrix multiplication again, in parentheses, the transpose of the weight. Sorry, it's this and this. Close the bracket, and then comma, then we now go back to the variance covariance matrix. So we've taken the variance covariance matrix and then the weights again, W1 and W2. Then double close the bracket and enter. So we have the standard deviation. Now for the Sharpe ratio, we have the expected return minus the risk-free rate, which is this, over the volatility or standard deviation. Okay, so we have exactly the same result, and at this point we want to optimize. So we want to do the optimization. It could be maximization or minimization. If we want to work on the Sharpe ratio to set the objective as our Sharpe ratio, then we maximize, because our aim is to maximize the Sharpe ratio. But if it is the minimization option, like minimizing cost, then we need to minimize the risk. So at this point, go to solver where you have values already. There may be using the PC to do something else, or maybe already working on it. You will need to reset all to get rid of everything. So get rid of all. Everything is gone. Then what do we intend to do at this point? What we intend to do is to maximize the Sharpe ratio. So maximize the Sharpe ratio. So click on this, and then this goes to this box. Then what next? By changing variable cells, the cells include the weight, the proportion of investment to be made. Then you move on to the constraint. Add constraints. The first constraint is that the sum of the portfolio weight, please, this must be there. The sum of the portfolio weights must be equal to 1. Otherwise, it could give you different values, positive, negative for the weight. We actually want the sum of the portfolio weight to be 1. It could give you some less than 1, greater than 1, but where you're restricted that the sum must be equal to 1, then Excel will do exactly the same as what you want, or will give you the result you expected. So this is a necessary condition. The sum of the portfolio weight must be equal to 1. So here we have equal to then 1. Okay, so Excel have taken note that the portfolio weight must sum up to 1. I want to add another constraint. My next constraint is that my portfolio weight should be positive. So the two weights must be greater or equal to 0. We call this non-negativity constraints. So W1 is greater or equal to 0. W2 is also greater or equal to 0. Or W1 and W2 are both greater or equal to 0. This is the non-negativity constraint. Okay, then what next? We want to obtain the solution. So we go to solve at the bottom. Solve. And then it's asking whether you want to keep the solver solution. Yes, we're happy to keep it. And then you could see. So this is the result. So you could see here that it's no longer the same for the equally weighted. You could see that the Sharpe ratio has increased. We now have approximately 78% instead of 69%. Approximately 78% in the nearest percentage. Different from the 69%. For the 69% is if the portfolio weights are the same, equal proportion of investment. But where we have unequal proportion of investment, different portfolio weights, then of course you could see that the Sharpe ratio will also be different. So we could see that the suggestion by the Excel solver in performing the optimization of the portfolio or carrying out the optimization here, we have 22%, approximately 22% should be invested on GlaxoSmith and 78% should be invested on BAT. And if this is done, then the mean variance portfolio investor will have a positive Sharpe ratio of about 78%. So by implication, it could have, yes, it's taking more risk because the risk have increased in this case. You look at it, the previous risk, the volatility of standard deviation was 0.1483 and so on. Here we have 0.16486 and so on. So you could see at this point, more risk, you are taking more risk, but with the aim of having a higher return. So if you look at the return, it's greater. Initially, we have 0.1324 and so on. Here we have 0.15. So you could see 0.13. Here we are having 0.15. A higher return in this case. So the return is higher than the previous. Because at this point, we are optimally allocating risky portfolio, the weights, so that we could have different weight, different proportion of investment, rather than having the same proportion of investment. So this is what we've obtained. We could also go further to do more and more for the optimization. Other than this, we could also go to minimization. Maybe we want to minimize the risk. And in minimizing the risk, we also let Excel know that the portfolio weight will sum up to 1. And then you let Excel know that you want your Sharpe ratio to be a specific value. If you do that, Excel will still compute and return the correct result with no issue. All right. So at this point, we are moving on to the final part, which is the efficient frontier curve and the capital market line. So to do this, this is what we need to do. We need to assign portfolio weights or allocate portfolio weights to the two assets. So GlaxoSmith W, BAT W, this the portfolio weight for GlaxoSmith. This is the, asset weight rather for GlaxoSmith, asset weight for the BAT. We could also have it as W1 and W2, no issues, that's fine also. So here, let's assume we'll begin with minus 0.6. Like I said, in principle, we could use positive and negative weight, especially when we want to construct the efficient frontier curve and the capital market line. But those negative ones will not really contribute. It is the positive weight that will really be useful. But we just need it in order to have more data points while trying to obtain the curve or the graph. So we have minus 0.6, and then here we have minus 0.5. Then we could drag it down. I like this to drag it down. Let's assume we'll drag it down to this point. You could take as many as you want, but sometimes don't take too much. So we'll take it up to 1.2. And again, remember that the sum of the portfolio weight will be equal to 1. So for each set of weights. So in this first set, W1, W2 here, what you have will be 1 minus this value. So we have this. And then you drag it down up to this point. So we have all these values. So you could see that the sum of the portfolio weight is equal to 1. If you sum this, if you want to find out, you could also do this. This plus this equal to, so you could see 1. The sum up to 1, the same for all. Each row, take the sum of the portfolio weight for each row, the result should be equal to 1. If it is different from 1, go back again and ensure that this necessary condition is satisfied. Now, we want to obtain the volatility, which is the standard deviation. And at this point, what do? We use the formula. This will be the square root of W1 square, sigma 1 square, plus W2 square, sigma 2 square, plus 2W1, W2, covariance of W1 and W2. Sorry, covariance of 1 and 2. If you are taking the covariance option. But if you are taking this, remember the covariance, the correlation coefficient is equal to the covariance over the individual standard deviation. So if we have the correlation coefficient, the correlation coefficient will be equal to the covariance, let's say for 1 and 2, over the standard deviation for 1 times the standard deviation for 2. This is all we have, all right? So if we make the covariance the subject of the formula, then the covariance will be the correlation coefficient times the standard deviation for 1 times the standard deviation for 2. So if you are using the correlation coefficient formula, then of course you work out this. But in this case, we're using the covariance. So that's fine. So the covariance will be the correlation coefficient times the standard deviation for asset 1 times the standard deviation for asset 2. So take note of this, just to let us know or remind us of the formula. All right. So at this point, we go ahead to obtain the standard deviation. So this is the square root of this weight square, the weight for GlaxoSmith square, that is raised to the power of 2, times what again? The standard deviation, which is this for GlaxoSmith. raised to the power of 2 plus the weight for BAT is square times the standard deviation for BAT is square plus what follows? 2 times the weight of BAT times, the weight of GlaxoSmith first, times the weight of BAT, but it doesn't matter, anyone could come first, but let's take it in this order. Then times the covariance. So you could take this or you take this. It's the same, take this covariance. And close your bracket. Don't enter yet. We need to lock some values, those that we brought from other cells completely. So these values, J3 and J4, need to be locked. That's the standard deviation for GlaxoSmith and BAT. So highlight it, and in your keyboard, press F4. The same way here for J4, highlight this value, and in your keyboard, press F4. And we do the same for this R4, for this value. In your keyboard, press F4. And then enter. So we have this result. Highlight and drag it down. It will do the same for all. Okay, let me go back again. I highlight this and I drag it down up to this point. So it will do the same for all. So I now have the volatility. Remember, they are all positive in value. We have the volatilities. Now, the expected return is more easier, even though you're dealing with as many assets as possible. But for the volatility, the formula looks a bit longer, especially when you're dealing with 3 assets, 4 assets, 5 assets, and so on. But that's not an issue so long as you've done it for the first case. You drag it down, it will do the same for the rest of them. All right. For the expected return, we have the weight of GlaxoSmith times the mean of GlaxoSmith plus the weight of BAT times the mean for BAT. Again, we need to log these values, I3 and I4. That is the mean for GlaxoSmith and the mean for BAT, which were brought from different cells. So to log them, in the highlight each, and in the keyboard, press F4. So that's done. Do the same for this. Highlight I4, and in your keyboard, press F4. So it will be locked, and then enter. If you don't do this, it may give you different result, depending on the version of Excel you are using. So it's advisable to actually lock if you want Excel to recognize and do the same for other cases. So at this point, we'll drag it down, highlight, and then drag it down. So we have the expected return for all. Then what there is a Sharpe ratio? It's important to include the Sharpe ratio because it's from this Sharpe ratio you'll be able to discover your optimal portfolio, the portfolio with the highest Sharpe ratio. And that will help us also to construct or obtain the capital market line. If it is for the efficient frontier, we only need this volatility and expected return. So at this point, what do? Let's work on this also. So we have the expected return. Sorry, the Sharpe ratio will be the expected return minus the volatility over, so close the bracket first, over the risk-free rate. And again, the risk-free rate, we need to lock it. So we have this. Enter. And we have this value. So you could see the first instant negative Sharpe ratio. You drag it down to this point. Oh, sorry. I think I did something differently here. I did something differently. This is the expected return minus the risk-free rate, rather. Sorry. The expected return minus the risk-free rate over the standard deviation is the correct formula. Then we lock the I6. The risk-free rate, which is brought from a different cell. Highlight, and in your keyboard, press F4. Then enter. So we have the first value, and then we drag it down. And it will do the same for all. Now that we have this, we want to take a look at which of them gives us the highest Sharpe ratio. Look at these values. You will see that the highest Sharpe ratio is somewhere here. This. So at this point. (0.77). The rest are less than that. So maybe I like this if I want. Let's assume I'm happy with this. You could change color if you're not happy with this light green. So here we have the optimal portfolio. So the suggestion here is that 20% should be invested on GlaxoSmith, 80% should be invested on BAT in order to obtain the optimal portfolio. So here we have a Sharpe ratio of 77.5%. If you go here and change this, that is exactly what it will be for the Sharpe ratio here. If we do that. All right. What do we need to do next? We want to obtain the efficient frontier curve. So to obtain our efficient frontier curve, we need to highlight the volatility and the expected return. Remember, the volatility will be at the horizontal axis, x-axis, while the expected return will be at the vertical axis, the y-axis. So I like this. Take it down to the last observation. So we have this. Then we go to our top icon, click on Insert. From Insert, go to Chart, and then take the chart. Could take this scatter with smooth lines and markers. Could also take this, any of them, but we're happy with this. So you can see that this is the efficient frontier curve. Now we want to show these labels. So click on this, axis label, axis title, chart title, and so on. We'll also go to data label, but we're happy with this. So here we have the efficient frontier curve. And here we have the expected return. Expected return at the vertical axis. Then at the horizontal axis, we have the volatility. We could bold them if we want. Bold this. could do the same. We want to bold this also. We could also change the color of this. Maybe we're happy with blue. Efficient frontier curve. So this is the efficient frontier curve. You could copy if you want to copy and then paste it anywhere. That's fine. So now you could see that it is in the form of a parabola. Now we have this, all these portfolios. We don't need all these ones. Sorry, all these dots. We don't need them. We only need these ones. These are the efficient frontier. But the mean variance portfolio is this. So this is the mean variance. It will be somewhere here. The mean variance portfolio will be somewhere here. We could also go here and we'll go to text. First of all, insert, and then illustration, shape, text box. And then we have this MVP. The mean variance portfolio is somewhere here. We could take it up. Or leave it here, and then I bring this arrow to point it. So this is the mean variance portfolio. So we trace this value for the volatility corresponding to this value. And of course, we could also have the text box. Where we have the optimal volatility and the mean. So this is just like X, Y. And then you bring it to this point. Go move it. So the X and Y. We can enter the real values, you trace it. For instance, if you move your cursor to this point, it will be showing you 0.1485. That's for the X. And then for the Y. Sorry, for the Y value, I enter the X. Okay, yeah, this for the X value, that's fine. For the Y value is 0.1324. So this is the optimal, say this is the minimum variance portfolio. Please, the minimum variance portfolio is different from the optimal portfolio. The minimum variance portfolio is just giving us the smallest amount of risk at a corresponding expected return. So we could see here, this is the Markowitz theory. This, from the efficient frontier curve, this very value here that is leaning on the edge of the curve at this edge here. So this is clear. We have the efficient frontier curve. We want to do something else. The next thing we want to do is to obtain the capital market line. and thereafter we are done. So let's assume I get all this off. Let's assume I don't want this anymore. I get this off. Okay, so the next thing I want to do is to work out this. I need to have the weight, the volatility, and the return or expected return. So the formula is as follows. Take note of this formula I want to state here. Now, to obtain the capital market line, CML, we do this. We will have this for the volatility. We will have the optimal volatility, or the weight rather first, times the optimal volatility. So the weight is denoted by W, then multiplied by the optimal volatility. And for the expected return, we will have the portfolio weight times the optimal return plus 1 minus the portfolio weight times the risk-free. So this is all I've got. Take note of this formula. We'll use this to work out what we want. Okay, could use this yellow if I want, or use this. That's fine. So for the capital market line, we have that the volatility will be the weight times the optimal volatility or standard deviation. Then the expected return will be the weight times the optimal return. That is the optimal portfolio return that you have here, this one in green. Then plus 1 minus the weight times the risk-free rate. Enter this. Okay. So here we assume that we have, let's say, 0, weight, 1, and 2. You could also use other numbers, not necessarily 0, 1, 2, but just given an instance here to see if this will actually agree, because I'm trying to select numbers that falls within the range. Because here I got from the portfolio weight from minus 0.6 up to 1.2, which is fine. But at this point, my weight, I'm just taking values between the 0, which is this point, and 1.2. So I take 0 and then 1 and 2. I just take it at this point. So now the volatility, this will be, remember the formula we've got here to obtain the capital market line. We want to derive this capital market line. So the volatility will be the weight, which is this weight, times the optimal portfolio volatility, which is standard deviation. Look at optimal. So the optimal volatility will be this. So click on this value. Then remember to lock it. We'll lock this value, we'll bring it from a different cell. So highlight, and in the keyboard, you press F4. Then enter. So you will see that the volatility will be 0 in the first instance, because in this case, the risk assigned here is 0 for the risk-free rate. That is the approach. So we'll take it down to this point. So we have these values. Again, for the expected return, remember the formula here. The weight times the optimal return plus 1 minus the weight times the risk-free rate. So this will be the weight, which is this, which is this weight times the optimal return. Just to show us, look at the optimal portfolio. So the optimal return will be this value. (0.017). Then plus 1 minus the weight, which is this weight, times the risk-free. And the risk-free rate is somewhere here. Let's go back to our work. This is the risk-free. Oh, sorry. I don't know what this does. So it's equal to this weight times this value. Just to show us clearly, this is the value plus, in parentheses, 1 minus the weight times the risk-free. So let's take the risk-free rate. And the risk-free rate is this, 0.03. Now we need to lock these values. The risk-free has to be locked because we're bringing from a different cell. Also, 0.17 should be locked. So look at it. The expected return here will be the weight times the optimal portfolio return plus 1 minus the weight times the risk-free rate. I take it again. The expected return is the product of the weight and the optimal portfolio return plus 1 minus the weight, and that is times the risk-free interest rate. Enter. So we have exactly the risk-free interest rate, which is 0.03. This will always be the case. Take note, whenever you are constructing the capital market line, for the first instance, you will have the risk-free interest rate as the value. Then highlight and drag it down to this point. And then we have this. So now we want to add this value to our efficient frontier curve so that we will see the capital market line. So go to this, right click, then you go to select data. So what we want is add. Click on add. Series name, CML, which is capital market line. X value, the X values will be these volatility values, because the volatility is always at the X axis. Then the Y value. The Y values or series Y will be the expected return. Take note. Now you could see it's already there for us. It has done it for us. If I go back again to say cancel, I want to show us again, like I said, you click on this, right click, select, add, then CML, capital market line. X values will be these values. And then you go to the Y values. Don't mind, it could be behaving crazy because you haven't entered all the values you want. So this is the X values, this to this. Then the Y value, series Y, you have this to this. You can see that it's already done for you. And then OK. So you could see the capital market line. OK at this point. So it's done for us. So we now have efficient frontier curve and the capital market line. So EFC and the CML. So this is the capital market line, this straight line. And clearly we can see that the capital market line makes a tangent with the efficient frontier curve. And you could see here, this is the optimal portfolio. Look at the values we've got here. This value somewhere here. 0.1673 for the volatility, and then for the expected return is 0.159. Now check 0.1673, 77, and so on, 0.159, 732, and so on. So you could see this one that is colored the same color of the capital market line. So this gives us the result. So it's quite easy to obtain the efficient frontier curve and the capital market line. So by implication, all these ones are not accepted. We only accept those ones that are leaning on the efficient frontier curve on it here from this point. All those ones above, not the one below. Then this is suggesting that is this capital market line is suggesting that the optimal portfolio is this very value. So we trace it from the graph, point X, point Y. So in this data point where we have the value of X, that is the value of the volatility, and the corresponding value of the expected return will give us the optimal portfolio. So we perform portfolio optimization, and in particular, the mean variance portfolio optimization for two assets, GlaxoSmith and BAT. We have also done optimal risky portfolio construction. We've computed the expected return, the volatility, and the Sharpe ratio. And again, we have obtained the efficient frontier curve and the capital market line. And we can see clearly in this video that the capital market line makes a tangent with the efficient frontier curve. So that's what is expected to be. The capital market line must make a tangent with the efficient frontier curve. If it does not make a tangent with the efficient frontier curve, then the result is wrong. So you need to revisit and do it again. So thank you so much for your attention, and thanks for watching this video. If you're also happy with this video, do well to subscribe and also click on the like button to show that you're happy. Thank you so much.